What's up, everyone? My name is Ale. Welcome back to my world of stocks. Now, something that a lot of you might not be aware of is that Warren Buffett actually has a secret stock market portfolio that is almost never talked about. But in today's video, I'm going to show you exactly what it is and why so few people are even aware of its existence. I'll let you know what stocks it owns. I'll even give you my quick opinion on some of its largest holdings, just do kind of a quick rapid fire on them. And I'll even rank those stocks from best to worst based on my own opinion, just to make things even more fun and interesting in the video. So I hope you guys enjoy this. I think it's going to be a fun one. Please subscribe to the channel if you haven't already. It really helps keep the channel alive and it means a lot to me. But with that said, we got a few things to cover here, so let's not waste any time. Let's go ahead and dive straight into this. Okay, now when you think of Warren Buffett's stock portfolio, we all tend to think of his, hedge fund-like company, Berkshire Hathaway, that holds over $300 billion of assets under management with some giant positions in stocks like Apple, Bank of America, Coca-Cola, American Express, and Kraft Heinz, just to name a few. However, back in 1998, Berkshire acquired an insurance company called General Re for over $20 billion, which makes sense since Buffett has always loved investing in these type of finance and insurance related companies. Well, what few people are aware of, though, is that General Re has an investment subsidiary called New England Asset Management, which holds a huge stock portfolio of close to 200 different stocks that are together worth almost $6 billion. Obviously, there's no way I could run through all of those stocks in just one video, but what's interesting is that the 5 largest make up over 80% of the portfolio, and the 10 largest make up over 90% of the portfolio. So I'm just going to run through the 10 largest stocks here, since that makes up the vast majority of the portfolio, and I'll rank each of these holdings from best to worst based on my own opinion as I go through the list. Okay, but starting here with the first stock, that's going to be, well, no surprise here. It seems that Buffett is likely controlling much of New England's portfolio himself, since the number one largest stock of all of it is Apple, which is also by far the largest holding of Berkshire. And yeah, New England has it at a massive close to 50% of the entire portfolio, which is worth close to $3 billion. Now, I'm invested in Apple myself because I love how sticky their business is, with so many services running on close to 2 billion various devices being used all around the world to keep people hooked onto the ecosystem. Not to mention that they have one of the best balance sheets ever, with over $200 billion of cash and investments that they can use to help fund new growth opportunities and be able to enter new markets in the future. But having almost half of your portfolio in Apple is way too much, in my opinion. This is a stock that barely even dipped this year when so many others have crashed into the ground, and it's still sitting at north of a $2.5 trillion market cap. So I just think there's larger gains to be had in smaller cap stocks at this time. But regardless, I do own Apple stock myself, so I'm gonna have to rank them as number one for now until I see anything else on the list that I consider to be better. Moving on to stock number 2, though, that's going to be US Bank, ticker symbol USB, at over $800 million and making up close to 14% of the entire portfolio. Now, you guys know me though, I don't usually invest in bank stocks other than JP Morgan Chase. It's the only one that I own myself because I just feel that it's the best run of the bunch and it gives me more than enough exposure to what is otherwise a pretty risky sector given the horrible macroeconomy that we're currently in. However, I gotta admit that US Bank does look like a great alternative at today's prices, since it is already down close to 30% from its highs, leaving it with one of the most attractive growth-oriented dividends out there that already yields over 4%, and yet it still carries a low payout ratio below 50%, a double-digit growth rate, and a double-digit growth history. I won't be buying USB myself, but I can definitely understand why others would want to own it. They've got some strong sales, solid profitability. They've got revenue growth of over 8% expected this year and another 17% plus next year. That's really high growth for a bank. Plus, it's currently trading about as low as even the most bearish analyst price targets right now. So I think overall, you've got here a value stock with some surprising growth and a fantastic dividend. I think that alone earns them the number two ranking for now, at least for now, until I see something better. On to stock number three, though. That's going to be another bank, and no surprise here, it's Bank of America, which is also the second largest holding of Berkshire Hathaway. And here it's about 12% of the portfolio and worth over $700 million. Now, similar to USB, though, you can see here that you're talking about a bank stock that has been crushed because of the horrible macro economy, leaving it down over 30% from its highs, and with a valuation that is also about the same as USB. Both stocks are just slightly above the sector median. However, their revenue growth is about half the percentages of USB, and their dividend yield is also much smaller at around 2.6%, while USB is way higher at over 4%. So I gotta rank Bank of America a couple spots behind USB at number 4, since I like USB quite a bit more at this time. Okay, now stock number 4 is thankfully not just another bank, it's actually a tech company. And this is one that is mostly famous for their computers and printers, and that is HP, ticker symbol HPQ, at around 9% of the portfolio and worth over $500 million. And it was also one of their largest recent purchases, as they increased their position by 11,000% last quarter. So a big purchase here that they made in HP. I've never really liked HP that much though, because even though they are consistently profitable, they're usually very low growth. I mean, in fact, these next couple years are actually expected to be revenue declines, probably because of the weak macro economy and the lower demand for computers coming off of the pandemic. But the stock itself is currently down almost 35%, leaving the dividend yield pretty high at over 3.6%, with some excellent growth metrics on it. So if you're looking for a value stock with a great dividend, then sure, maybe you'd want to consider them. But for me, the business is a little too boring, it's too low growth. I mean, I've never even heard anyone ever brag about owning an HP computer or a printer, and that's coming from someone who actually owned both of them myself in the past. But ultimately, I think it's the least attractive stock that we've seen so far, so I'll rank them behind Bank of America at number 5 for now. Okay, next up, we've got the oil and gas giant Chevron, ticker symbol CVX, at over $300 million and making up over 5% of the portfolio. And, when it comes to energy, you guys know me. I would prefer pure play renewables for the higher long term growth opportunities. However, given the current oil and gas crisis around the world, oil companies like Chevron have been making a ton of money, with sales expected to soar by almost 50% this year. I don't expect this current crisis to last forever though, and neither does Wall Street, as their revenue growth is expected to decline a bit next year, at which point I think oil stocks may return to their normal, cyclical, and pretty volatile behavior, as you can see on this chart here, which is something that I've never really been interested in owning myself, and right now Chevron is trading at some of the highest levels. However, they have been using their large profits that they've been gaining recently to invest in renewables, and they've been increasing that in recent years. In fact, they recently just made a $3 billion acquisition of Renewable Energy Group earlier this year, and even through the volatility, they've been able to grow their dividend for over 3 decades in a row while still carrying a very low payout ratio and a high yield of 3.6%. Given that the yield is about the same as HP, but financials are a lot stronger, and I think they are, making the right moves, investing in renewables, and oil and gas is not going to disappear, at least not soon. I'm actually going to let them steal HP's ranking of number 5 for now, and I'm going to slide HP down to number 6. I don't plan on owning Chevron, but, I can understand why maybe others would want it. Okay, now the final 5 stocks include some ETFs and are only worth around 1% or less of the portfolio. So I'm just going to run through these a little quicker, but coming in at number 6, that's going to be a SPDR ETF, ticker symbol SPY, SPY, that tracks the broader S&P 500 index, which is a collection of some of the largest companies in the market. And there's not really much to say here. I mean, if you want to invest in the broader market, then something like this can be ideal for you. And yeah, currently it's down over 15% from its highs, which we know that, dips in the stock market are usually good buying opportunities if you're thinking long term. However, I think it's way more fun and even more profitable to pick individual stocks rather than just owning the broader S&P 500. So, for me personally, I'm going to have to rank them all the way down at the bottom at number 10 since I know that I'm probably never going to buy it myself. However, I do think that it's a great choice for more casual investors that don't, want to put the time and the effort into properly researching individual stocks. Next up, though, we've got yet another bank stock, but this time it's going to be Bank of New York Mellon, ticker symbol BK, which again, I'm not interested in owning another bank myself, but in comparison to USB and Bank of America, Mellon is also down about a quarter of its value this year. However, their PE ratio is slightly higher. USB's dividend is significantly higher than theirs, and both other banks have gigantically higher growth, and it's not even close. So I'll put Mellon, far lower than both of these, and I'm even going to put them behind HP at number 7. Okay, for our next stock though, we've actually got a very interesting one in Diageo, ticker symbol DEO, which is a foreign ADR stock as they are actually a British conglomerate that owns famous alc brands. I have to say alc, hopefully you know what I'm referring to, but they own famous alc brands like Guinness, Johnny Walker, Smirnoff, and Crown Royal, just to name a few of the over 200 brands under their roof. Now, the ALK market is also very large and it's not likely to ever disappear, which has led to very strong financials with solid profitability over the years that also allows them to pay a pretty nice dividend of over 2%. However, the biggest issue that I have with them is that there is very little analyst coverage on this foreign stock, with literally nothing to look at on Yahoo Finance in terms of revenue or profit estimates, which is why I tend to stay away from most foreign stocks myself if they don't get a lot of coverage, just because, I feel that I don't really have the free time required to properly research and keep track of some of these stocks as an investment in my portfolio. But considering that and the fact that their valuation is still slightly higher than the sector, despite a 20% dip this year, but it is still trading even higher than pre-pandemic levels, I'm just not all that interested myself to be picking up this stock at this time. I still like them a little more than HP though, so I'm going to squeeze them in between Chevron and HP at number 5, and I'll move the other stocks up a ranking to fit them in. Okay, we are now left with the final two stocks, and these are actually just ETFs, so I'll group them with the Spider ETF and give a quick summary and ranking for all of them right now. Now, like SPY, IVV also tracks the S&P 500, while IEUR is what I refer to them. That's actually a broad mix of European stocks. I think it holds like over 1,000 of them, which are all based in already developed countries across Europe. So that's kind of interesting. And I think that's actually a great way of getting some broad exposure to European equities without having to stress yourself out trying to research each individual foreign stock if you live here in the States. But here are the 5-year charts for each of these. Again, SPY and IV basically do the same thing, which is why their charts look almost identical. And then IEUR is going through a larger drop because the US markets tend to be stronger and more stable. The larger drop though for the European ETF, that leaves it with a significantly cheaper PE ratio of 13 versus the other two at 19. However, that of course also comes with the lower stability and growth of Europe. When looking at expense ratios though, which is the price that you pay for owning these ETFs, all of them are very low, something that you're probably not going to even notice. However, it should be noted that IV is significantly cheaper out of the other two than the other two, and it's by a significant amount. While it may be the cheapest though, it's also the one with the lowest dividend yield, and for that reason alone, I would actually prefer to own SPY over IV. That said though, it's actually the European ETF that interests me the most out of the three, since their dividend is much higher at over 5%, and at the end of the day, I can pick out American companies pretty easily, whereas I can't really say the same thing about Europe. So if I was forced to own one of these three, I guess I would probably take the broad exposure to Europe that I otherwise would struggle to get. So I'll rank them accordingly here, and that leaves my overall ranking as follows. I put Apple at number 1, I've got US Bank at number 2, I put Bank of America at number 3, Chevron at number 4, Diageo at number 5, HP at number 6, Bank of New York Mellon at number 7, the European ETF at number 8, SPY ETF at number 9, and then IV ETF at number 10. And you know what? Now that I think about it, I think I'd rather actually own any of these ETFs more than all the other stocks after US Bank. So I'm actually going to move them into rankings number 3, 4, and 5 and push the rest of those stocks up a spot to fit them in. That re-ranking at the end though should really tell you everything you need to know about my personal feelings on this portfolio. I do think it's a little boring, not all that interesting, and really other than Apple and US Bank, which I do really like at those two stocks, but other than that, there's not really anything on here that I feel compelled to research further or want to invest in. And that's usually how I feel about most Warren Buffett stocks. He tends to go for more value dividend oriented options, which I do like to have some of those, but I also like to have a mixture of more growth oriented opportunities. So I tend to not be the biggest fan of Warren Buffett's portfolio. But anyway, those are just my thoughts. That's the beauty of stock market investing. We all have our own preferences, our own biases, and we all like to have our own investing strategies. What is yours? Do you like any of these stocks? Are you invested in any of these? Or do you kind of agree with me that, maybe Apple and US Bank, there's a couple interesting things in here, but the rest is a little boring and not all that exciting? I'd love to hear your thoughts. Leave them for me down below in the comment section. I'll respond to them. And thank you so much for watching the video. Thank you for all the support, everyone. I really appreciate it. I hope you're all doing well. And I will catch you in the next one. Take care. Bye-bye.